Hello, everyone, and welcome to Abbott, Stringham & Lynch's webinar series on the 2017 Tax Act. Thank you for your time. Today we're doing a presentation on tax reform as it applies to corporations and businesses. To my right is Rob Trammell, another partner here at the firm. My name is Luis Ramirez. Before we launch into the webinar, I thought I'd take us a few minutes to just discuss some housekeeping rules. First of all, if you look at your screen, you should see a little icon on the top right-hand side that says multimedia. If you click on that, you'll see our presentation, our slide deck, and you can download those slides if you like. We're also taking some Q&A, some questions and answer questions. So if you have some questions, you can type it in the Q&A section of your screen. We'll wait till the very end of the webinar to address those questions. Hopefully we can get to all of them. If we don't, we will reach back and get a hold of you and circle back with you, and hopefully we can get to all your questions. In addition, after the webinar, we are going to put this up on YouTube. So if you didn't get enough of this good stuff, you can always go to YouTube and listen to it again or share it with folks. As far as professional education, unfortunately, we're not going to be able to offer some CPE credits if you're looking for some. And one more thing is there is going to be a survey at the end of the webinar. If you take an extra couple of minutes and give us some feedback, we would appreciate that. So my name is Luis Ramirez. I'm a partner here at Abbott, Stringham & Lynch, and I've been doing this for 30 years. And I think the thing I want to share with all of you is that this is a really big tax reform, and we're excited about putting this on. And I'm going to let Rob introduce himself, and we'll get started.
Hello, everyone. My name is Rob Trammell. I'm a tax partner here at Abbott, Stringham & Lynch. I joined the firm in 1998, and my areas of expertise are closely held companies and the owners.
Great. And the last thing, just for those of you who don't know a lot about our firm, I think we're a little unique in Silicon Valley. Abbott, Stringham & Lynch has been around since 1977. You're actually a graduate from high school, so we've been around for a long time. We had planned on being around for a lot longer. I think what makes us unique is that we're a large local firm. We're 100 people strong, and having a large firm like that, we like to think that we still have that personal touch and personal delivery that you get with a local firm, a smaller firm. But unlike a small firm, with 100 people, we're able to provide some expertise that you wouldn't get from a smaller firm. Our firm is organized along specified niches. So Rob is in the construction real estate group. We do a lot of that kind of work. In addition, Mike McAndrews heads up our corporate international technology practice. And being in Silicon Valley, we do quite a bit of that work. We have a non-for-profit niche in our firm. We have a family wealth planning group headed up by Julie Malakadayat and Bill Melton. And we do a lot of work with high net worth individuals and family wealth planning, and I think that's what makes us a little bit different, and I'm hoping this seminar series is an example of that. So without any further ado, we'll get started on the agenda.
Thanks, Luis. So we have a lot of things to cover in this agenda. You can see the agenda is up on your screen. It will come up on your screen shortly. There's three main items that we want to talk about. Oh, sorry, just a moment. So you can see the upcoming webinars are listed there. So we've got a series of webinars, and those are the ones that are upcoming. So back to the agenda. We've got a number of things to share with you. Hopefully we can get through all of it. The three big items we want to talk about and spend the majority of our time on are the new corporate tax rates and the impact on flow-through entities. Kind of entity choice discussion. Does the flow-through entity still work? Is the CCorp better now that we have lower rates? The next thing we'll focus on is there's been a quite substantial change in how companies can report for tax purposes between the cash basis and the accrual method of accounting. So we want to spend a little bit of time there. Then they've changed the rules as far as expensing of capital equipment. When you purchase equipment, when can you write it off, what the benefit is. So we're also going to spend some time there. After we get through those three items, what we'll do is we'll throw out a hodgepodge of things that we think are important just kind of at the end.
Thanks, Rob. And before we get into some details, I think I just want to share is this is the first major tax act we've had since 1986. So it's significant, it's far-reaching. Those webinars that we have coming afterwards, I think, are really important. I think probably the most sweeping changes are probably in the international area. In fact, we're still learning things today as we keep reading more and more law. So please stay tuned for those. If you're a company with international operations, you're going to want to tune into that. Okay, good. So the next slide, we're going to talk about tax rates.
Yeah, so the main item in the tax law that's been getting the most press for sure is the change in the tax rates. So you can see the old rule for the tax rates. We had graduated brackets, meaning as your taxable income got higher, the effective tax rate that you paid on that income got higher. You can notice the 34% bracket was quite substantial, quite large. So when you were over 75,000 of income all the way up to 10 million, you paid 34%. The new rule is, Steve Forbes would be happy because we now have a flat tax, at least on the corporate side. We have a flat tax of 21%, effective for tax years beginning after 12/31/17. So when you look at when you consider the 34%, 35% rate that we had versus the 21% that we have now, 13, 14% drop, that's huge.
Big difference. Yeah, it is, Rob. And I think a quick note here is that for a lot of our corporate clients that Rob and I work on, we always, again, this is C corporations, but we've always done tax plan at the end of the year, so we tend to bonus out some payments to our key shareholders and employees, and we're always trying to drive our taxable income down to those lower rates so we can pay a lot lower rate. It takes a lot of work to get down to $50,000 of taxable income when you have significant profit. So there was a lot of planning under the old rules, a lot of planning to try to drive our income down to get to these lower rates, and now we're just dealing with one rate, 21%.
Right, that's it, 21%. I read something interesting in the Wall Street Journal yesterday or the day before, and it was talking about the effect on really large corporations. And I'm sure you've seen in the press, Apple came out and announced that they're going to give all their employees $2,000 of stock-based compensation. Walmart came out and said they're going to do $1,000 to all of their employees. When they do the analysis of how much this rate reduction is going to save them, those expenses, that they're getting a lot of press for, are just de minimis compared to how much tax they're going to save. So this is a really big deal for a lot of large corporations. A couple of areas that we just want to mention as it relates to the rules. So C corporations, or corporations where you've got a calendar year end, it's pretty straightforward. For the year ending 12/31/17, you've got the old rules, the graduated rates. As you go forward into 18, you've got 21% effective rate. A lot of C corporations can have different year ends. So for instance, let's say you've got a year end that ends in March. So your year end started in April of 2017 and it ends March 31st of 2018. Based on the way the law is written, I assumed, and I think most people assumed, that you wouldn't get the lower rate until the next year because your year actually began in 2017. Then that's actually not correct. So you will get the benefit, fiscal year corporations will get the benefit of the new low rate according to when their year ends. So in other words, you're going to have a blended rate, so you'll have the old rules that apply to April 1st through the end of December of 2017, and you'll get the lower rate from January through March.
So in essence, you got 1 quarter at the lower rate. I wonder, it's a blended rate, right? So I don't know if there's a lot of planning you can do to push income back and forth. At the end of the day, it's just going to be a blended rate.
It's kind of a convoluted calculation. Yeah. I'm not sure that you would want to spend much time running through it, but yeah, it's kind of convoluted.
Okay. Yeah, and the last point is personal service corporation. So for those of us in the industry where we provide services, accountants, attorneys, doctors, we're considered personal service corporations. So the IRS, under the old rules, said, hey, if you've got a corporation and that does personal services, we don't want you to take advantage of these lower rates that you see on the slide. We don't want you to have income down to $50,000, only pay 15%. So the old rules for personal service corporations was that you pay tax at the highest marginal individual tax rate. And so we're not talking about individual taxes here, but I can tell you that under the old rules, that highest individual tax rate was 39.6. Under the new law, it's 37, but under the old law, it's 39.6. So if you had any income left over in your personal service corporation, you paid at 39.6 tax rate on that income. This law does away with that, and now it's just a flat 21% for all corporations. So if you're a personal service corp, and this is going to benefit you. If you leave any income in the company, you're going to save some tax money on this, and something to consider.
And so the next thing that we're going to talk about is probably one of the items that we've been getting most of the questions around, and that is the flow-through entities, the S corporations, the LLCs versus a C corporation. And simply the conversation is, well, they did lower the individual tax rates, but the highest individual tax rate is 37%. So if I have an S corporation and all that income flows through to me individually and I pay tax on my individual tax return at 37%, should I consider converting to a C corporation to get the benefit of that 21% rate? It's definitely a topic of conversation, and the answer is not that easy. We're going to go into some detailed analysis here and give you some numbers and some considerations. Just a little background. So typically the biggest reason to set up a flow-through entity was to avoid the double taxation. So when you hear people talk about C corporations, inherent in a C corporation is double taxation. And what that means is you pay tax at the corporate level on the income that the corporation earns. And then, considering the life cycle of the corporation, you want to get the residual money, after-tax money that you've left in the corporation out. So when you take that out to yourself, you're going to pay tax on it again. So when you add in both of those tax events, the effective rate ends up being fairly high.
Yeah, I guess said another way, Rob, a C corporation as opposed to an S corp or partnership or some other passive entity. C corporation makes $100 of income. Under the old rules, it paid roughly 40% in tax. There was $60 left over. If you wanted to take that money back out, you would pay a dividend. You declare a dividend, you pay that $60 out, and then the recipients, the shareholders, would get that dividend and then pay dividend rates on that income. So you'd have a double tax on that level of income. That's where the double tax comes from. And that's an important concept to understand, because that's one of the primary reasons that we advise a lot of clients that you should really consider a passive entity, because we don't have that issue. The passive entity, again, S corporations, partnerships, LLCs, single member LLCs, all that income flows through to you, and the income and the tax is paid at the individual level. It passes through the entity down to the individual. So back to Rob's point, here we got a 37% tax rate on the federal side for individuals for my pass-through clients, but I've only got 21% on a corporation. If you're a company that doesn't pay a lot of dividends and never took a lot of dividends, that's a serious consideration to take, and we'll go through some of those details in our next slide.
Yeah. One of the things before we leave this slide is I need to give you a little bit of background, because we're going to do a comparison on the S corporations to the C corporations. But the flow-through entities under the new tax law also get benefit. So the 37% highest individual tax rate is a little bit misleading. So the pass-through deduction, which we will focus on in our webinar on February 7th exclusively on that particular issue, we'll just give you a little bit of the general stuff now, so it helps, because it helps in our analysis of entity comparison. But the pass-through deduction is generally a 20% deduction from your income that comes from your flow-through entities. So just very simply, if I've got an S corporation that earns $1 million of net income, I pay tax on that $1 million on my individual tax return. Assuming that it qualifies for the pass-through deduction, I'm going to get a deduction of $200,000, or 20% of the million. Effectively, I will pay tax on $800,000 of my individual tax return. If you think about it, what that has done is it has brought down the individual tax rate. So just a little background, because you'll need that as we go on to the next slides. All right, so just a quick little analysis. C corporations, so the federal rate, as we talked about, is a flat rate of 21%. California has an 8.84% rate, so the effective rate is 27.98. For some of you engineers out there or mathematicians, you'll notice that those numbers don't add. The reason is because you get a deduction for the state taxes that you pay on the federal side. So it pulls the effective rate down to, let's call it 28%.
Okay.
On a pass-through entity, as I mentioned before, we've got the highest individual tax rate of 37%. We've assumed California at 12.3.
And that could be higher, Rob. I think the top rate in California could be 13.3.
Right, 13.3% is the highest rate for California. We've assumed 12.3. Again, you can see those two don't add, but what we're doing is we're assuming that the pass-through deduction applies, so you're getting a 20% deduction on the federal side for that income. It pulls down the effective rate to about 42%. So just simply, when you compare those two numbers, you might say, well, geez, I can save almost 14% by converting to a C corporation. That's entirely true on the surface, but is that the end of our discussion?
Yeah, and if I'm a company and I'm looking at my tax rate and I'm looking at taxes and I'm going 14% and maybe even 1% more, right? Because if I'm at the 13.3%, which is not that hard if you're a high income taxpayer in California, lots of clients that pay at that 13.3% rate, so it's more like maybe 15%. And if I'm making $10 million of income, that's 1.5 million. If I'm making $5 million of income, it's $750,000. That's a lot of cash that I can use to put back in my business, to grow, to make acquisitions. That's a lot of money that I'm saving in taxes by converting to a C corporation.
Yeah, that's exactly right, and that's some of the analysis that we're going to go through. So C corporations, as we mentioned at the outset of this discussion, they still potentially have double taxation, meaning you've got that C corporation that's accumulating a bunch of income, you're happily paying your 21% federal rate of tax, but you're leaving a bunch of money in the corporation. Well, the IRS can come in and say, geez, you've got a lot of accumulated earnings in there. We think it's about time that you pay that out to yourself as a dividend. So once you do that, the dividend is not deductible to the corporation, so you get no benefit there, and it's taxable to the individual, either at 15%, 20%, probably 23.8% when you add in the effect of Obamacare or the Affordable Care Act. So you add in the 21% plus 23.8%, and you've got 44, 45% effective rate by the time you're done.
Yeah, very, very true. And I'm going to permit me to go back up one level here. I just want to make one more point on the previous slide. The key note in this slide is that C corporations get the benefit of deducting their state income tax on the federal return. That's what drives that rate down to 28%. That is not the case, and so here is we have to default and give you a little bit more information on the changes in the individual tax law. What we did not mention on that second bullet point with the pass-through entity is that for federal purposes, individuals can now only deduct $10,000 of state and local taxes, and that's relevant here, right?
Yeah.
Because again, a pass-through entity is paying tax at the individual level for the federal tax and California tax, and now I am no longer, as an individual owner of a pass-through entity, going to be able to deduct my state income tax. That's why that rate is so high, and that's why it's important to mention that. And so I'll go back to this slide, back to Rob's point about the accumulated earnings tax. That doesn't go away. There's some issues there with earnings. Any good CPA can walk you through and help you mitigate against those issues. So double taxation is very real, and it's mostly, I think in my mind, the dividend is not so much of an issue. There's lots of corporations that don't pay dividends. I know in the Midwest, there's generations of family businesses that are C corporations that go from one generation to the next generation to the next generation, and they don't pay a lot of dividends. Occasionally they do. So the double tax, I think the biggest double tax issue comes in a sale transaction or a potential sale transaction. Because if you were to sell your C corporation assets, that's where the double tax really comes into play, because again, pay tax at the corporate level, now you got a corporation with a bunch of cash and no more assets, and that cash has got to come out. That's a double level of tax. That's an issue. There's other circumstances around that are a lot more detailed conversation, but it's something that double tax is an issue. It all depends on the facts and circumstances of your particular situation.
Yeah, and that's a really good point. So one of the other things that we mentioned on the slide is that the 199A, but that's the pass-through deduction that qualifies SCorps, LLCs, a number of entities. It's complicated, and not everybody will qualify. Suffice it to say that the entity conversation, the entity type conversation just got more challenging.
Yes.
Because everybody's situation is different. What is the life cycle of the company? What do you intend to do? How are you going to pull money out? You know, all of those things become important because we're playing with different tax rates at the corporate level, at the individual level, at the beginning of the entity, at the end of the entity. Just suffice it to say that each conversation is a little bit challenging and has some intricacies.
Yeah, I completely agree with that. I think in my mind, in order to have, you know, a well-informed decision, I think you have to answer a few questions. How much, if you're a passive entity, how much of this 199A deduction, there's lots of different names for it, but how much of this new deduction am I going to qualify for? Am I going to get the full 20%? I think that's the most important thing you have to know if you're a passive entity, and then that'll determine your true effective tax rate. Once you know your true effective tax rate, now you can form a comparison. Now you can do an analysis. And then you can ask yourself, well, okay, well, maybe SCorp is not the best way to go because of these reasons. And one of those reasons is I'm not going to pay a lot of dividends. I am pretty sure I can structure a stock sale and not have to worry about this double tax issue when it comes to the sale of my corporate assets because I know I can sell the stock. And that, when you sell stock in a C corporation, there's only one level of tax. And it's at the lowest tax rate possible, capital gains, with the exception of 3.8% net investment income tax from the Affordable Care Act. But I think the takeaway here is you know, my mind, if you're a growing company and you need every single dollar of cash because you're growing and you're reinvesting your business and you've got a plan to grow by a certain percent and you don't want to take on debt because debt can be expensive, right? You borrow money, you have to pay it back with after-tax dollars. You don't want to bring in a new investment because that gives up equity. But if I can put an extra $750,000 in the corporate coffers that I can use to go out and hire people, buy equipment, and virtually and can get comfortable with a stock sale, this is a serious conversation. This is something you need to consider.
Yeah, all very good points. So we got to keep moving on. We got a lot of things to talk about. As we mentioned, so probably that last issue of the flat corporate tax has gotten the most press. For us, I think the next thing that we're going to talk about for our practice, for our clients, this is a really big deal. And it's really exciting to us because it gives us a lot of opportunities to plan. So let me kind of give you a little bit of background on what I'm talking about, and then we can go into the details. When you file your tax return, generally, you've got two different methods to use when you file your tax return, a cash method or an accrual method. IRS, for years, ever since I've been in practice, has been fighting the cash method and wants you to use the accrual method. They think the accrual method is more a true reflection of matching your income and your expenses. And there are laws around who can use the cash method and who can't. So typically, if you have inventory, there's limits on using the cash method. If you are a C corporation and your average annual gross receipts exceeds $5 million, you can't use the cash method of accounting. And generally, when we have the opportunity to choose between the two, we would choose the cash method just because it allows us to kind of manage the income a little bit better.
Manage is a good word.
Right. So it just allows us a little bit more flexibility. I think from a cash perspective, cash method is better because if you think about it, if you're on the accrual method, you're paying tax on your receivables when you invoice them. So, you know, if somebody's not paying you for 60 or 90 days and you invoice somebody a client at the end of the year, you could potentially be paying tax on that money before you even get the cash.
Right. So in a scenario where you have a company, just to kind of do a primer on accrual method, at the end of the year, I only have, I look at my balance sheet, I have $2 million of receivables, $500,000 of expenses. Those $200,000 receivables are included in my taxable income, right?
$2 million, yeah.
Yep, but I get the benefit of writing off $500,000 of accrued expenses.
Mm-hmm.
But on the net, $1.5 million of income is showing up on my tax return that I got to pay tax on, and I may not have the cash for that.
Yeah, that's exactly right. So what the new law says is effective for years beginning 1/1/18, they've really loosened up who can use the cash method of accounting. And basically that $5 million figure that was in the previous law now goes to $25 million. And it's not, they don't really look at average, they just look at your last year. So if your prior year was $25 million or less in revenue, you are eligible to use the cash method.
That's huge, and why we both think that is huge. Well, first of all, I've spent a lot of time in this area. I know Rob has spent a lot of time in this area. Our firm, spends a lot of time in counting methods and periods. I can tell you that, generally speaking, growing companies are always better off on a cash method than they are on a accrual method. There's some exceptions, but for the most part, if you're a growing company, you're better off in the cash method than on the accrual. And this is the main reason why. If you think about it, if your revenues are growing every year, then conceivably your accounts receivable are growing every year. So as long as your accounts receivable are growing every year, you're always going to pay less tax on the cash method of accounting. So now with this $5 million limitation going away, going up to $25 million, if you're on accrual method right now and you're eligible for this, this could be a huge deduction for you on this next year's tax return.
Yeah, that's exactly right. So to follow up on Lewis's example that he gave, accrual basis corporation, so let's say at 12/31/17, that's all you had. You had $2 million of receivables and $500,000 of expenses. So your taxable income on your tax return would be $1.5 million, and you'd pay tax on that. If you were cash basis, you had billed the $2 million, but you hadn't collected it until 2018, let's say. You had recognized the expenses of $500,000, but you hadn't paid them. So you kind of flipped the scenario in that your income for 2017 on a cash basis would be zero, right? Because nothing's happened. In 2018, you would recognize the income from the $2 million that you actually deposited and received. You'd also get the benefit of the $500,000 in expenses. So you'd have income of 1.5, but of course the benefit is you have the money. You could have spent it out on other things, but at least you collected the cash. So how does it work when you make a change from accrual method to cash method? Because I would imagine that a lot of you are going to be talking to your practitioners, or we're going to be talking to you about some planning opportunities. So for 2017, again, to our example, you would have had income of $2 million. $1.5 million.
Yeah, and 17, these rules aren't effective until 2018, right?
Yeah.
Okay.
So then you get to 18 and you're under the 25 million, so you say, hey, I want to be cash basis. That's great. So in 2018, what we do is, for tax purposes, we calculate your income as if you're on the cash basis. So it's going to get a little technical here, but let's try it. So for 2018, you're truly on the cash basis. So in 2018, you collected the $2 million and you paid the $500,000. So from a truly cash basis, you'd have income of 1.5. Well, you say, wait, hold on a second. I already paid tax on that 1.5
right.
in 2017.
Because that was accrual basis last year, right? So I already
exactly
picked
right.
out the income. Right.
Yeah. So what happens is we file a change in accounting method form. It's a 3115 that goes with your tax return. But we also figure out what the effect of the change is. And so what happens is you get a deduction in 2018 of the $1.5 million, because if you didn't, it would be double taxed. So in 2018, it creates a huge adjustment, a negative adjustment, typically based on the difference between your receivables and your payables, right, and really reduces your income in 2018, which creates some really nice planning opportunities.
Yeah, absolutely. We can't overemphasize this. If you're eligible for this change and you've got significant receivables, when you look at this in 2018, you need to plan for that, because if you're making estimated tax payments, you finish your 2017 return, we all know how we pay estimated tax payments, right? Usually based on the prior year liability. But if you know you're going to have a built-in $1.5 million tax deduction, not only are you going to you start saving that tax immediately from the reduction of estimated taxes at the end of the year.
Yeah, and you've got that $1.5 million deduction in 2018. And think about it, if your receivables continue to go up in 2018, even though your book income is going to appear large, you don't pay the difference you don't pay tax on the increase in your receivables.
Exactly.
I mean, we got to take a look at the numbers. You got to do an accrual to cash change, but there's a lot of opportunity there. Right. One of the things that I'll say is that we've done this before for clients where they're eligible, and if you've got a lender, a bank that you're giving your financial statements to, oftentimes they're going to ask for your financials and they're going to ask for your tax return. And so when they get the tax return at the end of the year, they're going to say, well, how come you had $1.5 million of income on the financial statements but zero on the tax return? And so it can cause a little bit of
Well, I think they
explanation.
usually say, I've got really good CPAs, that's why I did that. So our job is to try to lower your tax liability, but at the same time, your financials still look good. You're still on a GAAP accrual basis, so that looks good to your outside users, but you pay a lot less tax.
Yeah, I mean, like Louis said, we can't overstate the amount of planning opportunities that this brings up. Increase from 5 million to 25 million is just huge. There were a couple other things that they also loosened up as relates to the $25 million. We'll just run through these, but if you're under 25 million, you're no longer subject to Section 263A, which is the Uniform Capitalization Rules, which I think came in 1986 or something.
Yeah, that was the last major tax change.
And the general idea is that if you're a distributor or retailer, you meet certain income amounts, or you're a manufacturer typically. If you're producing goods and you have overhead expenses, G&A expenses, the government wanted you to capitalize some of those expenses as part of your inventory. So you couldn't write them all off. You had to add some of those expenses to your inventory. It was a very convoluted calculation, and we would run through it because the service required it. But it's nice to see that we don't have to do that anymore for those corporations that are under the 25 million. If you have inventory, just because you're under the 25 million, it doesn't mean that you can just go ahead and expense your inventory as you pay for it. You still need to account for the inventory. It's just called something different.
Yeah, it is. They treat them as materials and supplies that are substantial. There are some rules there. We can guide you through those rules, but they're much more favorable than if we call them inventories.
Yeah, and so when we make these changes, the accrual to cash, the no longer subject to 263A, we're changing our accounting method, because when we filed our previous returns, we elected a method. Now we're changing it. We've kind of alluded to this before, but the 481A adjustment just calculates the impact of that change. And if that 481A adjustment is negative, you get that adjustment in the year that you make the change.
Right. Yeah, that section is named particular code section of the code, but that's the avoidance of double tax. So that's back in the example we said earlier. When we file a change in accounting method, it's an extra form. It's an automatic change. Some changes you need the permission to change. This one's going to be automatic from the IRS. You file it with your tax return, and you tell IRS, I'm switching to the cash method. I'm deducting $1.5 million on the return this year, and this is how we got there. That's what that adjustment does.
Right, and then we've also got some good news for our construction clients, our contractor clients out there. So you file your tax return on the accrual method, but the way you recognize revenue, to the extent that your receipts exceeded $10 million, you were required to use percentage of completion, right? And if you use that, you're familiar with it, but the basic concept is if you were working on a contract at the end of the year, long-term contract, which means it basically just extended from one year to another, you would have to recognize the estimated profit on that job based on how complete the job was. So if you thought on a particular job you were going to make $500,000, and at the end of the year you were halfway done, you'd have to recognize $250,000 worth of revenue. So the $25 million expansion applies to percentage of completion.
Wow, so that's kind of like receivable, right? You've done this job, you've got to pick up income, even though you're not done with the job. So that costs you money.
Yeah.
Right.
Yeah, that's exactly right. The interesting thing is that this is not really a change. The IRS doesn't consider this a change in accounting method, so we don't have to go through the 3115. We don't have to calculate the effect of the 481A. This is really a cutoff change, which means any contracts that you entered into before 12/30 or up to 12/31/17, if you used percentage of completion and were required to use percentage of completion, you still use percentage of completion for those contracts.
Okay.
For contracts entered into after 12/31/17, if you're under the 25 million, you can now use completed contract or a different method if you want. You don't have to use percentage of completion.
Okay, so Rob, back to your example. If I've got a $500,000 profit job And under the old rules, I was 50% done. I picked up $250,000 of income that year, and then presumably $250,000 the next year, right?
Yeah.
But if this were 2018 and I had that same job, if I didn't finish that job until March of the following year, I pick up zero.
That's right. In 2017. Sorry, 2018. Right. That's exactly right.
Got it. So it's kind of like cash method almost, maybe.
Yeah, that's right.
Yeah, wonderful.
The other thing that comes into play here is percentage of completion percentage of completion is an estimate, right? So you make an estimate of how far you're along in the project, you estimate the profit, and then you pay your tax. Well, the government always said, well, those are estimates, so let's look back when you finish that contract and see how the profit actually fell out in the different years. And what they're worried about is you ultimately paid tax on whatever the profit was, but maybe you paid tax in a later year when you should have paid it in an earlier year, and there's this calculation called a look-back calculation where you would look back at the contract and figure out whether you owed the government interest on the tax that you shorted them in a previous year. So if you don't have to do percentage of completion, that goes away.
Wonderful.
That look-back calculation goes away.
Right.
So again, that's a big deal for us, and I think it's going to make it a lot easier for people to plan. It creates a lot of opportunities, and I'm sure that we'll be talking to a lot of our clients about that because it affects a lot of our client base. The third item that we wanted to focus a little bit on is capital equipment. So most of you are probably familiar. Under the old law, we've got two different methods of basically accelerating our write-off for capital equipment. The government, if you buy a piece of equipment and it's expected to last longer than a year, you write that equipment off over the estimated life of what the property is.
5, 7, 15 years.
7, 10, 15, 39 for non-residential rental property, that kind of stuff, non-residential real estate. There's a couple different methods that we could use or options to accelerate those expenses. The first is bonus depreciation, or one of them is bonus depreciation, and the second is called Section 179. And again, that's just the code section that allows us to expense some equipment in the year that we purchase it. So we will start by looking at bonus depreciation and what the changes were under the new law. The current law is for 2017, under bonus depreciation, you could deduct 50% of the cost of qualified new property. For 2018, that percentage would have gone down to 40% of qualified new property. The new law, it's changed. The new law, you can deduct 100% of qualified property placed in service. There's an interesting date there, 9/27/2017. I think that was when the first tax bill was drafted. So you can take bonus on that property after that date. And then the 100% applies for property acquired before 2023.
Yeah, so it's interesting that these dates. There's going to be an individual tax webinar, and you'll hear about the new tax rates if you tune into that. I briefly described it in the last webinar. But all these changes in tax rates for the individuals expire in around year 2025. And the reason why that is that in the current environment, and there's certain budgetary restraints that we have when we pass major legislation, the so-called Byrd rules, named after a senator. And these rules say that if you're not going to get a supermajority on the passage of new tax legislation, the budget has to remain balanced over a 10-year period. So this tax act is expected to generate a $1.456 trillion budget deficit. So a lot of people think that it'll spur economic growth, and we won't see that. But the original estimates are we're going to see a $1.45 trillion deficit in our budget. So that's why you see some of these odd dates. They're allowing us to expense all this, but later on in the years, they're going to stop that and to check it to see if they have to reverse it or not. So that's why you see all these odd dates, and this 10-year budgeting cycle comes into play. So another interesting thing that I think Rob said is that the old rules for bonus depreciation was for the cost of new property, right? Okay. So we're going to expand that a little bit more when we talk about how these changes take place. But I just thought I'd mention these odd dates and how they work.
Yeah. So we'll get to that change, but the last point on that page is So for 2018 through 2022, we've got this 100% bonus depreciation. For the 4 years thereafter, it basically phases out at 20% clip. Who knows what will actually happen, but that's the way the current law is. What Lewis was getting at is, I mentioned under the current law for bonus depreciation, it only applied to new property. So it had to be new property, not used property. So under the new laws, they changed the definition of what qualified property is. They made a change to a recovery period of 20 years or less with certain computer software. That applies. So we can get a lot of assets under the 20-year life. The big thing that Lewis was alluding to is now for bonus depreciation, used property also qualifies.
Yeah, and I think that's a big deal. And let me give you one example of why I think it's a big deal. Usually you don't go out and buy a lot of used property, right? You're not going to buy a used tractor. But what does happen all the time is that you do make acquisitions of other businesses, right? Yeah. And lots of times we structure those deals where we're buying assets. And so, if you buy a capital-intensive business and it's got a lot of equipment, you're going to want to allocate purchase price of that equipment because you're going to get an immediate impact on your ROI with 100% expensing of that purchase price allocation. So for those of you who may be in acquisition mode and you're looking at buying companies, the purchase price allocation takes on more importance.
Yeah, that's a very good point. And particularly, this bonus depreciation component has no limit.
Excellent. Right.
Right? I mean, 179, we'll get to that, but there was a limit on what you could write off under 179. So we would always be going to our clients and saying, how much did you purchase? Was it new or was it used? So we could figure out which methodology would be better. The bonus, 100% bonus depreciation, there's no limit. So you go out and you buy a company for $50 million and you can get $25 million into, fixed assets that you could write off immediately. That's a nice incentive on the purchase price.
That's right.
You still have the option, like we had before, to elect out of bonus depreciation if you want to. I see we've got a typo on there. I apologize we should know how to spell depreciation, but, that's the way it goes.
Depreciation.
Yeah, exactly. Let's move on to Section 179. So they made some changes to Section 179. The 2017 limit on how much you could expense under Code Section 179 was $500,000. The Code Section 179 applied to new and used property. So 179 you could capture under used property, but not for bonus. For 179 there is a phase-out threshold, which means if you exceed that amount of acquisitions, eligible acquisitions, the amount that you can deduct is reduced dollar for dollar. Under the old law, the exemption amount was $2 million.
So Rob, how does bonus work with 179? Does one render the other one irrelevant? Are they both the same? How do you see that playing out?
No, I wouldn't say that it renders it irrelevant, that one renders the other irrelevant. We're going to talk about some definitions of, what you can take under 179, what things you can deduct under 179. So I think there's still some intricacies as relates to, it depends on what you're acquiring. It's nice that new and used property both qualifies under 179 and bonus. 179, you have a limitation on how much you can expense. So if you purchase more than a certain amount, your deduction under 179 might be zero, and all you're left with is bonus. One of the important things, and the point that's next on the slide, is the 179, the new law also expanded the definition of what qualified 179 property is. So you can make improvements to your non-residential real estate, your commercial real estate now, qualified improvement property, and you can expense that entirely under 179.
And that's huge. So so out of this new law, and you'll get more details on this when we do the real estate webinar, but out of this new law, there's a new term that comes out of that. It's called qualified improvement property. There's some definitions around that. But if part of your real estate is qualified improvement property, it qualifies for this 179 expense, which, you can take $1 million worth of deductions immediately.
Yeah.
So yeah, that's a big deal.
Yeah. So these rules are changing quite substantially. If you recall, a number of probably, 4 or 5 years ago maybe now, the IRS came out and issued the tangible property regulations, and basically the idea was to provide us with more definition on the lives and how we could depreciate things. It affected a lot of people who owned commercial buildings because they required that if you bought a commercial building, commercial piece of property, you had to componentize that acquisition price. So typically what we would do in the past is we would say, you paid $5 million for a building, we'd allocate some to land, we'd allocate some to the building, and the building portion we'd depreciate over 39 years.
It's a long payback, right?
Yeah, well,
Right.
what the tangible property regulations said is, you need to componentize the different assets that you bought, so you break them down into HVAC, electrical, those types of things. And while you may get a quicker depreciation life on those, and that would provide you with some benefit, we didn't have this 179 option to expense those directly. So this is going to be nice if you're acquiring a building. You probably want to look at segregating those assets and consider whether you can get a quicker deduction on some of them.
Yeah, I completely agree with that. Cost segregation is actually a little cottage industry. We use consultants in that area, and you get very favorable results when you componentize your building. I do want to mention here, and again, it'll be brought out more in the real estate webinar. If you do have this, or your company owns a building, please keep in mind there were changes made in the like-kind exchange rules. Like-kind exchange still applies, but only for real property. So if you've done a lot of cost seg work and we've classified some of those acquisition costs to personal property, and you plan on doing a 1031 like-kind exchange down the line somewhere, you're going to want to look at that, because you may not get 100% exchange treatment on the total cost of that building. So something to consider.
Yeah, that's a really good point. We've got about just under 15 minutes left. And so in the last 15 minutes, what we're going to do is we're going to touch on a couple of other items that we think are important as included in the bill, not as important as the first 3 things we talked about, but they definitely will have some impact. So we'll just run through those. The first one is the corporate alternative minimum tax was repealed. Most of you are familiar with this. It's just a different way of calculating your tax. You pay the higher of the 2. It applies at the individual rate at the individual level as well. There was talk that they were going to repeal the individual alternative minimum tax. That didn't happen, but the corporate AMT was repealed. So we don't have to do those calculations anymore.
Yeah, I think my only comment on that is if you have any international operations, I'm not quite so sure the AMT's gone away, because there is this new term called guilty tax. This guilty tax, in essence, in my mind, looks like a corporate AMT tax. So if you've got an international operation, stay tuned.
They made a substantial change as it relates to net operating loss deductions. So some of you are familiar with the old rules related to net operating loss deductions. Let's assume in 2017 you had a loss of $1 million inside your C corporation. You had an option of carrying that loss back for 2 years. If you had tax that you paid in the prior 2 years, you could carry that back, offset that tax, and put some cash back in the corporate coffers. And there was a 20-year carry forward. So to the extent that you didn't carry it back, or there was no income in prior years, you could carry that loss forward for 20 years. The new law completely did away with the carry back, so it's gone. You don't have that option to go get money, to go get the previous tax that you've already paid. There is an indefinite carry forward, so there's no limit anymore on how long you can carry it forward for. The catch is, and you need to be careful here, is that let's assume in my example you had $1 million loss in 2017. Is that what I said?
Yeah, 17.
Now you have $1 million loss in 2018. You can't carry it back, so you carry it forward. And let's assume in 2019 you have $1 million of income. They've limited how much of that loss you can utilize carrying forward to offset the income that you have in subsequent years. So you may be thinking, hey, I've got this big loss carrying forward. I'm going to use that and offset all my income that I've got in subsequent years. Be careful, because it's not the case. So in my example, in 2019, you've got $1 million of income. You can only use 80% of that $1 million of loss you've got carrying forward, or $800,000. So you're going to pay tax on $200,000. So just keep that in mind. It used to be that you wouldn't have that tax liability, but now you do, and that's kind of a gotcha. The last item on this page was, it's not really important. It was just more a commentary on our current political situation, and I would expect that sexual harassment fees, they'd allow those to be deductible, but apparently if they're subject to a non-disclosure agreement, they're not anymore. But anyway.
Yep, interesting. The times we live in.
There is something we've never seen before. They're limiting the amount of business interest expense that you can deduct on your corporate tax return. They're limiting it to 30% of the business adjusted taxable income. So let's say that you have $1 million of taxable income. Your interest expense can only be $300,000. To the extent that it exceeds that amount, you get to carry the difference forward. So let's say that you had $400,000 in interest expense. You could deduct $300,000. The $100,000 carries forward, kind of like charitable contributions, I guess. If you don't use them, you carry them forward. The good news is that much like the method of accounting rules, they put a safe harbor in there, and if you're under $25 million, you're not subject to these rules. So you can continue to deduct interest as you have.
Yeah, I think most of our clients, all of our clients have some kind of interest expense if they borrowed from a line of credit with their bank, and 30% is a kind of high number in my mind, but I would see it more common if your company was a candidate for a private equity investment. And the private equity people are going to come in and then fully leverage that transaction, which they typically do. Then I think you start bumping into this. So if this is probably something where we have leverage transactions, looking at that interest expense is something you're going to want to do to see if it's completely deductible.
So overall, maybe what they're trying to get is more debt on the balance. I mean, more equity on the balance.
Maybe, yeah, or just not allowing the deduction for all that debt that's been taken on.
Yeah. Okay. Another thing is some of you have been benefiting from the domestic production activities deduction, which we commonly call DPAD, basically for those who manufacture in the United States.
Construction companies too.
Construction companies, yep. If you produce something in the U.S., if you build something, generally you may qualify for this deduction. It was a deduction that was 9% of the income that came from that activity. That's gone.
Yeah.
I think probably replaced by the 20% pass-through.
That's what I would think. Yeah. Because most of the people that qualify for this qualify for the 20% pass-through. So
yeah. One of the other things is self-created property like intangibles, IP, those types of things. It used to be that if you sold that in a liquidation or a sale event, you could take capital gain from that sale. So there's no more capital gain treatment on that stuff. And then the last thing that we want to talk about, which is a big deal for our clients and the area that we practice in, is they're changing the deduction related to research and experimentation expenditures or R&D expenditures. Under the current law, under Code Section 174, you have an option. You can expense those as you pay them, or you can make an election to amortize them or write them off over time. That option to expense them is going away. So, if you spend $1 million on R&D expenditures, whether it's in the U.S. or whether it's offshore, you lose the ability to write off that in the current year.
Yeah, and that's effective in 2022.
It's effective 2022, so we've got a little break for 18 through 21.
Yeah, it's a small blip on my radar, but it's a blip on my radar. It's at the very end, outer end of the scope, but it's something that's far-reaching. That's a big deal. We have a lot of companies that are mostly loss companies, right? And they're mostly loss companies because they're investing heavily in R&D.
Right.
You have VCs, putting money in a company, and most of their expenses are R&D, and all of a sudden, this goes away, and they have to capitalize it.
Yeah.
That's going to add money to the bottom line. Hopefully, you have enough NOLs built in. But again, back to what you said earlier, 2022 rolls along. I have an R&D company. It's got lots of NOLs. All of a sudden, I have to capitalize R&D expenses, and I can use 80% of them.
Right.
I'm paying tax.
You're paying tax.
Yeah.
Yeah, so you better, over the next 4 years, you better decide if your R&D is going to pay off.
Yeah. Or maybe we always spend a lot of time in trying to qualify R&D because we wanted to get the credit.
Right.
Maybe it's not R&D anymore. I don't know.
Yeah,
So,
maybe.
we'll,
And so just to finalize that point, if the R&D is done in the U.S., you get to amortize it over 5 years. If the R&D is done offshore, your amortization period is 15 years. So they're just encouraging U.S. production or U.S. R&D.
Right. Yeah. So you know, we're almost out of time. I think we might be able to take a few questions. Let me just kind of just say some concluding remarks here. I've been doing this for over 30 years. I started practicing in 1980, end of 87, right after the 1986 Tax Act changed. So I can tell you that Rob and I and lots of people in our firm have spent a lot of time, energy, money, reviewing all these tax changes, and it's very rare. It's very rare to see a tax reform to this impact. It was monumental to get the 86 Tax Act changed, and it was very monumental to get this to pass. I don't think we're going to see any huge major adjustments in the tax law. I think that, you know, again, we've got midterm elections coming up this year. We've got a new presidential election coming up 3 years from now. Who knows what's going to happen? Will it completely change? I don't think so, but there might be some nuances that change. But I think this is mostly here to stay, with maybe some minor changes over the time based on the political whims of our Congress. But there is some serious reform here, far-reaching on the international side, favorable for the corporation. So stay tuned. I think we'll be meeting throughout the year and discussing this further. So any questions that we can get to?
So there's a question asking what's self-created property. So self-created property is just something that you develop internally. It's not something that you go out and contract for. You don't hire somebody to do the work for you. You just develop it internally. There's another question about taxpayers and the 30% limit on interest expense. Yeah, I think we touched on that. If you're under the 25 million, that limitation doesn't apply. So if you're under 25 million, you don't have to worry about that 30% limitation.
Carry forward of NOLs. If you had, does that mean we would still be able to carry forward 2017? Absolutely. Any 2017 NOL you have for this year, you have the option of carrying it back 2 years. If you don't have any income in 2 years, you're forced to carry it forward. And then next year in 2018, you're not going to be able to use 100% of that. Yeah, you'll be stuck with 80% in 2018. So plan accordingly. And one more question is that should my S corporation change to C corporation? I think we touched on that. It really depends on facts and circumstances. You really need to look at it individually to see what makes the most sense.
Yeah, I think there's a lot going on in this Tax Act. We've just touched on a few things that we think are important to our clients and our client base. It's going to require further discussion. The answers aren't as easy as they used to be. So, you know, we look forward to hearing from you. We look forward to your questions, and we thank you for being a part of our webinar. We hope you found it informative.
Thank you, everyone.